Let's have a look back at what happened on Wednesday evening when the US Federal Reserve decided not to cut back on its $85 billion monthly stimulus package. I was getting ready for a really nice evening of UEFA Champions League football, and it suddenly got ruined at around about 1 minute past 8 South African time when the S&P was up 10, then 15, then 20, all-time record highs. It looked very, very spiky indeed. What is the fallout after this? On the line now in London is Joe Rundle, who's the head of trading at ETX Capital. Joe, it was quite a surprise, wasn't it? The PR department at the Fed really needs to do some work.
Yeah, and I think it's not just the PR department. The Fed's really only credible weapon at trying to sort this crisis out is what they say, and the markets can believe what they say, and they've actually been completely shot now. So I don't really know what the Fed can do in the future. They can't cut interest rates, they can't add more QE, and they can't signal what they're going to do in the future. So the Fed almost becomes redundant at the moment.
Everyone was talking 10 to 15 billion. I mean, that was the consensus. I mean, there were hints from several of the FOMC members that that would be the case, but suddenly they came out and shocked, handling things incorrectly.
Yeah, I mean, the Fed have done such an amazing job at managing to wean the market off its addiction to QE. And before Wednesday, if you had looked at it, you know, the thought of doing QE in September 6 months ago would have caused a market meltdown. They managed to manipulate the market round that the markets were actually sitting on near all-time highs, and then they've gone and done something which no one really expected them to do. And now no one's actually going to believe what they say in the future, so they're going to try and signal the end of QE at some point down the line, and no one's going to pay the slightest bit of attention to them now. So they've really lost all credibility within the market, and that's not just the PR, that is Mr. Bernanke, and that could be his legacy.
Yeah, of course, the market doesn't really care too much about credibility. It's not in the business of being credible, it's in the business of making money, and everybody seems to be long at the moment. I just said to our previous guest that maybe that leaves the market a little bit vulnerable. Are you getting that sense as well?
Yeah, I think the market is probably in a healthy situation. I think US corporates are strong, and I think the US economy is actually stronger than the Fed is making out. So I think the fundamentals are positive. You've now got this big overhang and question mark as to when QE is going to be withdrawn. The Fed are now going to try and signal it maybe for the end of this year and maybe into the beginning of next year, but now no one's going to pay the slightest bit of attention. So I think the real danger here is that the market is going to push interest rates around to where it wants them or where it thinks they should be without listening to what the Fed's saying. So you effectively have got interest rate rises in America in the real underlying mortgage markets, and the Fed can't do anything about it anymore.
Yeah, indeed. I mean, the US 10-year was at 99.5–3% at one point. Of course, it's pulled back there in terms of its yield. And you talk about the US economy going a little bit better than the Fed makes out, but on the other hand, the participation rate in the labour market is at its lowest since the 1970s. And maybe that's what Mr. Bernanke and his team looked at, and they said, look, we said that when the labour market picks up, then we will start tapering, and we can't justify doing it because then we would be going against our word.
Yeah, and there is a certain case for that. I think really what the Fed should have done is just tapered a little bit, maybe 5 to 10 billion, just to get the market to believe that what they say they actually follow through and carry on and do. Realistically, whether it was 10 billion, whether it was 5 billion, 15 billion, it's a relatively small amount of money compared to the money they've pumped in, and they're still underpinning the economy. But now it's such a big focus that they didn't do what they signalled, that they won't, people won't listen to them in the future. So it was just, I think, completely the wrong policy decision after 6 months of incredibly good work and incredibly good PR to have blown it in one decision.
Yeah, it's interesting you use that phrase, blown it, because I think they have as well. What's next now? We've got German elections coming up, and the mother of the German nation, of course, is going to have a landslide victory on Sunday. We'll get the results on Monday or Tuesday, something like that. But what is the market now looking forward to? Is it the next set of earnings? Is it the next shock? Is it Syria? Because quite honestly, the markets and the stimulus that drives the market seems to have shot their bolt as well.
I think we're going to see a good couple of weeks of upward movements. It's always going to be good that Mrs Merkel gets into re-election. That should be a shoe-in. So I think we'll see a positive market. I think the real risk actually is out of Europe. There's some rumblings in Greece now about banning a political party that's involved in some activism, and that could cause the breakup of the coalition. I really worry about the eurozone crisis rearing its head again, and now Mrs Merkel's going to have a mandate to do something a bit more drastic this time, because she's not up for re-election should she get in. So I think that's the biggest risk. And then of course, come towards the end of the year, people are going to start saying, when are the Fed going to start tapering? They're going to try and announce it, and they're going to try and give some forward guidance, but actually no one's going to pay the slightest bit of attention to them anymore.
So you think the eurozone might come back? We got fed up with the eurozone around about 9 months ago in South Africa, but what happened with that unpleasantness over the last few days with one of the a liberal person being murdered allegedly by the far right wing in Greece has sort of brought the eurozone back into focus. Do you believe that it's, despite the fact we've got PMI and GDP doing quite well, it could come back to bite us?
Yeah, I think the PMI and GDP figures are very misleading. Germany's having a fantastic time at the moment and is in a complete boom, and France to a lesser extent. You go to Southern Europe, they are really struggling. There is no job creation, there's huge unemployment, there's no sign of economic growth. And I speak to people on the street in Portugal and Greece, and they're saying, look, this is generations, 2 generations before we get out of this austerity program, and we just don't want to be part of the eurozone anymore. And that's, I think, the biggest risk, that you get a movement running on a very anti-euro ticket and saying we're going to just default on our debts and walk away, and it's going to put Germany in a situation where it has to make a really tough decision on whether it writes off debts or actually allows someone to leave the eurozone. That's the biggest risk to the markets, I think, at the moment.
And the most important question I've got to ask you now, Joe, is regarding something that's going to happen on late Sunday afternoon. It's called the Manchester Derby. It's the Etihad Stadium. It's Manchester City at home to Manchester United. City did very well in midweek by winning 3-0 away in the UEFA Champions League. Manchester United won 4-2 at home against Bayer Leverkusen. Who's going to get this one?
Well, my wife and her family are massive Man City fans, so I think I'd be strung up if I said anything apart from a very strong Man City win.